Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Sandeep Daga, founder, MD, and CIO at Nine Rivers Capital, joining in. Welcome to the show, Sandeep, and it's a pleasure to speak to you as well.
Thank you,
My
Hiral.
first question coming to you over here is amidst this kind of pandemic that all of us are dealing with, we have seen markets really rally from March lows to now. Clearly, what's happening is you are seeing some bit of participation that's coming in from the broader markets as well. If you could help us understand what is it that's actually driving small caps and mid caps, and what's the idea of investing in them right now?
Sure. So, Hiral, maybe I'll answer this in two parts. One is about the markets, and then we can be very more specific to small caps and mid caps. So, my view is that the knee-jerk reaction post-COVID, which all the markets, including Indian markets, witnessed in end of March, that I would say immediately got corrected because COVID-19 being a common denominator across all markets, all geographies, all economies, people realize that this is a washout year, and assuming that this is being a washout year, I think the valuation benchmarks were moved to the next financial year. So for us, it would become March 22. For certain other geographies, it would be December 21. And the moment you did that, you realize that things are not so bad, because things are going to come back. And then what happened is that, contrary to the very pessimistic estimations that the investor and the analyst fraternity drew up in the very beginning when the pandemic broke out, actually a lot of companies have surprised, in terms of their earnings that they have reported. I'm not saying that everybody would have reported better earnings than the previous quarter, but whatever were the estimates, they've actually done better than the estimates in terms of the fall in performance. And a lot of them have actually been able to weather the storm much better than anyone of us expected. And that kind of is fueling the interest back into equities, not just again in India, but I think it's globally. Even in the classic way, if you look at a valuation theory, it's what is equity valuation? It is basically, discounted value of future profits that you pay today. So a 1 year of profit loss does not lead to 50-60% of value correction, even if you were to do a DCF. Typically it will, even if you are conservative, it will erode the value by 15%. So there was no case to, for the stocks to fall so much, especially when this is a common denominator across every market. Now, coming to the small caps, as you know, that small caps, if you were to look at, over the last 3 years, small caps and mid caps were, have had corrected and were trading at historical lows. So why they have seen a strong resurgence is because very clearly now, when you saw a lot of the companies very richly valued, the large caps that were very richly valued, they seeing significant corrections in a post-COVID scenario, that led people to look back at companies where there was a lot of value and there is also growth happening. So it's not that all the small caps or all the mid caps have run away, but yes, the good quality ones with better outlook, who are in a way, in a post-COVID emerging economic scenario, they are relevant. They are the ones who are attracting maximum attention from investors, and therefore, you have seen that rally in some of these small caps and mid caps.
Right. That's an interesting read, Sandeep, that we pick up as well from you right now with regards to what's happening with small caps and mid caps. However, one of the biggest thing over here is that you know entry levels, when to enter a mid cap or a small cap, whether it's a good company or a bad company, or should we only look at technicals, etc., are always questions that are in the minds of retail investors. What are the rules, according to you, that one should follow while looking at these broader markets?
Sure. So, Hiral, this is a very good question because there is no one benchmark that you can pursue when you invest in small and mid caps, especially because a lot of these companies, are from the sunrise sectors where you do not have enough history on what's going to happen in that sector. So there is a lot of I would say, you need to do homework beyond the company into and try and model what's going to happen in an industry or in a sector, and then place that company as to how is it placed to capitalize on the opportunity that is beckoning for a certain company. So what my belief is that the best way to look at small and mid caps is to have a combination of value and growth in mind. You cannot just say that I'm buying a growth stock so I can pay any value. At the same time, you cannot just be swayed by a deep value stock, because you could be value trapped, and so often you would have seen that happening. What I would like to do here is give you the best way to look at any small cap is to look, to first draw up what kind of attributes you have looked at in successful small cap companies that have delivered huge returns in the marketplace. So maybe here I would like to use a slide which I can share, which
Sure.
people can look at, and I can also talk each of some points that I have covered. So I'll just share a screen.
Sure. If Abhishek,
So,
yeah.
so I'm just coming to, uh, can everybody, can you see the screen
Yeah,
here?
we can see
So
this.
this is what I wanted to, I think that, in our experience, all these small caps which have given trailblazer returns over the long term, small caps that have actually become now mid and large caps over the last anywhere from 10 to 20 years. So mind you, Hero Motocorp was a mid cap when it got listed,
Mm,
or a small cap, or a largish small cap, I should say. It got listed at a market cap of about 2,500 crores in
mm,
2001. And the journey of Hero Motocorp, everybody knows. Today, it's a part of Nifty. So what is it that goes? So the first thing that we look at is solid business franchise. Any company that has a solid business franchise, it's important for you to look at how good the business is. And generally, these guys are leaders in their respective niche spaces that they operate in, uh, or they are innovation led.
mm,
Innovation is can come, in tech companies, it comes from the intellectual property that they build, but otherwise there can be innovation in distribution, innovation in product design. So innovation has many facets, and oftentimes you also get to see opportunities where there is a huge operating leverage at play. This is very typical in manufacturing businesses where capacities get created,
mm,
capex cycles get over, and then you are going to endure a high growth phase where you are going to able to sweat the assets and create a huge value out of it. So those are situations typically where, but obviously the centrality is to be having a very solid business franchise. The second thing that we have seen, companies, and I'm going to, show you some after
mm.
this. I'm going to perhaps also take you through some of the examples. Mind you, none of these are our invested companies. They are just examples. So,
Hmm, hmm, hmm.
I'm neither recommending anything, nor I'm saying that we are anywhere
Sure,
invested
sure.
in any of these companies. So, or, we've seen that companies that have done very well in the markets, the entrepreneurs had a very narrow focus on their core business when they were growing the business initially as a small and mid cap company, and they also built a very strong second line of managers, empowered managers, and you can make that out, from the company's profile and the kind of people that they hire. Uh, they generally are addressing a very large market. The market
Hmm.
size that they address, and what we have seen is that companies that are part of oligopolies, duopolies or three or four players, and then say going and serving a certain segment, they have been able to create huge value in the marketplace.
Hmm.
Most of these companies grow, they have a focus on growing their business profitably.
Hmm.
Uh, you know, no mindless chasing of growth they do. And here I want to just take a moment to say that every bull cycle will bring companies and entrepreneurs who want to chase a growth mindlessly. I mean, a growth at all costs. And I haven't seen any such company really survive over the long term in terms of value creation. They may be surviving as a business, but from an equity value creation perspective, they get decimated. Uh, so obviously, when you don't want to chase mindless growth, so you're also debt averse. So, I would say that debt is a bad word when you invest in the small and mid cap
Hmm.
space. So look at either companies that are zero debt or very marginal debt, that from time to time companies would take. You would have heard this, they generate free cash flow. But one of the ways to really assess free cash flow generation of a business is to actually go longer term into the history and then cumulate the free cash flows, whether on a cumulative basis a company or a business generates free cash flows. Go back 10 years, go back 15 years,
Hmm.
and accumulate, because that gives a very good sense of, you can have 1 or 2 years because of a commodity cycle playing out that you make huge profits and generated a huge free cash flow. But can you do it on a sustained basis? You can actually go back and see, back test it much better over longer periods.
Hmm. Hmm.
In fact, we respect companies which pay income tax. Income tax, as a healthy tax rate, also indicates a very good corporate culture and the genuineness of the profits that companies are making. So do we do believe that that's one of the attributes of all good quality small caps which have delivered market return with very good
Hmm.
returns in the marketplace. And of course, the last thing is that, they should be high on the ESG quotient. When I say ESG, I'm not talking with the hat of a ESG fund manager. I'm saying in a more generalistic sense that companies, for example, let's look at a chemical company. Today, specialty chemicals are flavor of the day. All the companies have done very well.
Correct.
Now here, a good quality management would look at investing in environmental compliance, zero discharge, as a part of their risk management to future proof their profits. And then there could be companies who can shortchange by saying that let me manage the system, let me be compliant on paper, but
Hmm.
I'm taking risks which tomorrow one mishap can close my plant. So this is the difference between that, high on ESG quotient, when I say that, somebody who makes environmental or social responsibility as a part of their long-term corporate goal, rather than taking it as a cost and trying to cut corners.
Hmm.
And then last thing which everybody talks about, I don't need to say, is that corporate governance hygiene has to be good. You cannot, look at companies that, are they have very clearly, taken actions which are anti-minority shareholder,
Hmm.
and then and then now talking about saying, okay, we'll not do it again. It's seldom that happens. We've seen time and again, even in large cap companies, that corporate governance, again, it's culture, it's in the DNA, and that
Hmm.
DNA needs to be obviously checked. So what does this do? If you were, I'll just give you some examples now. So, Astral Poly technique, it came, somewhere in 2007, it got listed. And you just look at the kind of returns that they have. Don't look at the prices here. I'm just look at the graph. I just picked up these charts from Money Control. So the kind of multi-bagger returns that you've seen, this is almost a 100x stock in the last 12 years. And again, look at the patience from 2008 to 2012-13, it was nowhere if you look at the chart. And then, the returns came. So yeah, that's the other facet where if you have a belief in a business and the business is doing right, does not mean that the valuation will get unlocked tomorrow. You may have to be patient here to for the value unlocking to happen, and then the trailblazer return comes. Uh, Another one, PI Industries, specialty chemicals company focused on the agro chemical sector. So what a great with new suite of products, understanding that the whole world is going against chemicals and pesticides. So you need to move up the value chain where lower quantity of pesticides use should result in the same effectiveness that the older generation of pesticides used to
Correct.
do. That kind of moved the complete value chain, and they were at the forefront, and they've done so well. And again, these companies, if you go and look up all the attributes, you will see that they fit into all these attributes that we talk about. I picked up Honeywell Automation as an illustration again because it's a multinational. And look where it was trading, how it was available. Global company with so much of IP. And then there has been, from 2014 onwards, 4, 5, 6 years ago, from there onwards, how you've seen these returns.
Hmm.
And
Hmm.
these companies have now become mid caps and large caps, by the way. So, going back to your question, why should one invest in small and mid caps? Because those are the ones they eventually become large caps. Nifty composition has undergone a significant change from what it was 10 years ago and what it was 20 years ago. So, good quality small caps and mid caps can become real long-term compounders.
Right.
Now,
So,
I want to take one more slide, which is
hmm,
the reverse. How debt can decimate equity value. So here is a
hmm,
company GMR, good company, built great assets, but they went on a mindless chasing of growth, borrowing, and that's what has led to a decimation of equity value.
hmm,
Again, nothing wrong per se with the management or per se with what they were wanting to do, but they just wanted to chase the growth too much, and they ended up borrowing a lot.
hmm.
So this is what I would say, is this is what goes into successful stock picking, if I may to say, in terms of small caps.
Right. So, if you could just help us understand what are the common mistakes that an investor actually makes then while investing in these kind of companies?
Okay, so I would say that there are certain mistakes which are behavioral in nature, and then there are certain red flags that one needs to be always watching out for. And it's a combination of both these which lead to investors often making mistakes while investing in so again maybe rather than me I'll just again go and share some slides which basically cover something which you are asking. So here this I would call them as
Hmm,
stay away red flags.
hmm,
So what we have often seen is that one man shows. This is especially true for small caps. Seldom create seldom end up going and growing. Enterprises don't grow up to the size and scale as the opportunity offers. They kind of start to struggle at some level of growth, and then they kind of fall by the wayside. So I would say that if it's a one man show, a very centralized decision making, and there isn't a backup organization that you see, stay away, or if even if you invested, then, play the short cycle and get out. Second is always you will find in any bull cycle, there are these, so-called Midas touch rockstar managements who promise the moon. I'm not going to take any names over here, but frankly, they are disconnected from reality. If somebody tells that, I'm going to grow 50, 70% compounded next 5 years, and then that in a real business environment it's very difficult unless it's some kind of a venture funded tech business that can grow and continue to make losses. uh, we also, when entrepreneurs underplay risks and challenges, I'm talking about their business risks. Like for
correct.
example, if some of the automotive companies did underplay the electric vehicle risk initially. Everybody said, oh, they are too far away, they're not relevant for India, and whatnot. And we've all seen that they're mainstreaming, although it may take some time, but the fact of the matter is, even if EVs take 10% market share in a country like India over the next 5 years, it is going to disrupt the automotive value chain. You know, every automotive supply chain company will be left with excess capacity. So underplaying risks and business challenges also doesn't help. And these kind of managements usually underplay the risks. The rock star managements, as I want to call them. And they are close to questioning. So if companies or managements don't want to answer tough questions, then obviously you need to stay away. No focus, as I said, we really believe that companies should be. So if you find companies where, after initial set of success, suddenly you are seeing companies making now non-core diversifications, suddenly you find the group having new businesses being set up outside the listed company, a very clear sign, to change away. Your priorities are changing, your bandwidths are diverted, maybe your financial resources are being stretched, so no point in trying to invest in such. You do find accounting inconsistencies and numbers don't tie up, then obviously that's a no-no. One other good barometer to stay away is, when you look at too many related party transactions in a company which is still a small cap or a mid cap, again, something which is, I would say, a red flag. Equally important are the behavioral pitfalls. Uh, Please don't chase momentum. Losing sight of valuation is one of the biggest pitfalls that you can encounter while investing in small and mid caps. uh, Buying even a good company at super rich valuations can lead to a significant, correction in prices when the markets speak out or their own business cycles speak out. We've seen this in so many companies, and if you were to do a statistical analysis, even good companies tend to correct 30 to 60% from their peaks in, when markets speak out. So be conscious of valuation. Don't invest at any valuation. That's where I said it's always a combination of value and growth that I believe should work well for a long-term investor. Uh, don't ever fall in love with a stock. That all of us know. Don't look at the reality and take decisions. Uh, don't be in a decision paralysis. Don't wait too late to buy or to sell. I mean, this is typically what happens, when markets correct. You have liking a company and you keep waiting for further correction. So go by the fundamentals and the valuation and be prepared that there may be further a little bit of more correction. But if it sounds good. And likewise, when you have to sell, you in a bull market, so try developing a dispassionate investing skills. Don't be in love and don't try to time the market. This last two are very important, behavioral pitfalls. Heuristic bias, you start to extrapolate your personal experiences into thinking that this is going to work or this is not going to work. So let's say I'm a luxury end consumer and I look at a mass market brand and I say, oh, this is something which will not work. While in a way, it actually becomes, the masses want to consume that more and more, and there is a huge story building up. My heuristic bias is now not allowing me to take that call. So you need to be obviously managing your heuristic bias much better, not trying to extrapolate your own consumption behavior into what you're looking at. And you would have seen so many companies done so well, selling to masses or selling to the luxury, and it can be both ends. For example, iShare, who would have thought that they will be selling such luxury bikes, luxury in the Indian context, of costing several lakhs of rupees, when bikes were all priced sub 1 lakh. And therefore, so many people had that heuristic bike, India mein kya bikega, who's going to buy? But look what has happened. So that's what I mean by heuristic bias. And secondly is bias confirmation. You have a contradictory evidence at play, but you still don't want to, accept that. So these are, I would say, some of the mistakes that somebody can avoid. And then is there one more thing which I would like to say, that one mistake that often people do is, I want to highlight the importance of booking profits in small caps. You see, the whole listed universe is like a pyramid. You have a whole lot of what you can call as tiny caps or penny stocks. Then there are small caps. Few of these small caps can migrate and jump orbits to become mid caps, and even fewer can migrate and become large caps. So, what I would say is that, from time to time, if you have a certain thesis that you've built and the thesis is played out, do book profits. There will not every small cap can become a long term compounder. So,
Correct.
that's very, very important. And this is where most people falter.
Right. So, taking all of this into consideration, Sandeep, how should one spot value creation bigs in terms of the parameters that should be considered and the time frame that one should look at while investing in mid caps and small caps?
Uh, Here, my first, let's address the time frame. Any small and mid cap investor should not
Hmm.
have a time horizon of less than 5 years in mind for making an investment and getting out of an investment. So, the whole idea should be that your investment cycle in a stock should not be less than 5 years. It's another matter that the market may offer you opportunities to exit early because the markets are irrational. They go
Hmm.
into an exuberant mode from time to time. But otherwise, let us be very clear that the more long term, and 5 years is a good long term for small and mid cap investing. The more long term you are, then you are not at the mercy of the volatility of the market that you often see, and you are not going to, rather you can use the volatility to your advantage to buy a certain good quality small cap stock at very reasonable valuations when such corrections happen, and also try and maximize the returns by selling it in an exuberant market scenario. So that said, the time horizon has to be long term. I would say that look at any
Hmm.
company or any business that has structural drivers for growth. Now, these structural drivers can come on account of policy tailwinds or regulatory tailwinds that are available in certain businesses. They can come on account of a change in consumer behavior that is happening because of more disposable income that people are having now, or the credit culture that is catching up where people don't mind borrowing and spending. Or the enablement of a certain environment is allowing that change to happen. For
Hmm.
example, today the kind of digital content that we are consuming and more personal content that is getting consumed is directly impacting the TV content that used to be consumed in the yesteryears. That was the only form of rich entertainment as well as non-entertainment content that was available in the earlier years. With the advent of 4G and as we get into 5G environments, it's going to be more digital, it's going to be more personalized. Now, this is a consumption shift which impacts a lot of businesses and can throw up a lot of opportunities.
Hmm.
Similarly, I would say that, so look at structural growth drivers. Say, for example, the government's Ayushman Bharat scheme, which covers insurance for all up to 5 lakh of rupees. This is something which was not available earlier. So, a guy who had to go and treat himself would not go because he didn't have the money or his money had other priorities. But today, with this insurance scheme being available, the guy is definitely going to go and take advantage of that scheme, and that is going to spur consumption of pharmaceuticals, consumption of medical consumables in the healthcare industry. So this is structural in nature. It's not that overnight the Ayushman Bharat coverage will cover everybody and everybody will take advantage. So over the next 10 years, that this whole theme is going to play out. So companies that are going to be beneficiaries of this can expect themselves to can aspire to grow reasonably at a reasonable mid teens or more growth rate. They can aspire and grow that much, and that is a great play, because it's aided by such a big insurance, and it's happened in elsewhere in the world. Go to US, wherever the insurance coverage has gone up, you see what has happened to the healthcare and pharmaceutical industry. So these are, you need to pick up the structural drivers. You need to become comfortable with a structural driver that can drive a business, and then go and ultimately pick up a stock within that, looking at those some of the attributes that I listed. I would say that if you do that, then the likelihood of you landing up with a few winners is very high.
Right. And Sandeep, with this, what are the kind of risks, according to you, that are associated whilst investing in mid caps and small caps?
Oh yeah, risks galore when you invest in small and mid caps. As you know, so the three big risks that often gets highlighted, and they are the real risks, is one is you know volatility.
Hmm.
This universe has far witnesses far higher volatility. Second is illiquidity, which is connected to volatility. So illiquidity and volatility go hand in hand. But illiquidity also means that you cannot, if you want to sell on a given day, either you'll have to pay a huge impact cost, or you may not be sell at all because the stock may hit the lower filter. And the third risk is that of governance, where there will always be governance question marks uh, in many of these small and mid cap companies. And how do you get over that governance comfort, because some of the question marks may simply be because there is not enough information available, and therefore how do I make assessment of like how you see very good quality annual reports giving so much of information that the governance comfort comes from the statements emanating from the chairman to the board of directors, their report. But here you may not find that elaborate communication that comes from the company or from its board, and therefore it's not necessary that these companies are not good, but the question marks, you need to get over that. So my view is that volatility and liquidity risks can be addressed if you are a long-term investor, because you don't want to sell on a bad day when there is no liquidity and a market is in a panic, because you are long term and you are looking at a horizon where, and you have invested in a good company, so you don't really panic. And volatility, as I was telling you earlier, actually can then become an advantage rather than a disadvantage, because
Hmm.
you would take advantage of volatility to buy and sell. Uh, However, for a short-term investor, these can be deadly. So that's why again and again we say that when you look at small and mid caps, don't chase momentum, don't look at the short term, because you can get caught on a wrong foot. If you want to, if you want to buy a house and you are saying that, okay, let me create an equity portfolio which can give me returns to buy a house, don't
Hmm.
invest in small and mid caps. Start investing in small and mid caps after you bought your house, so that this money is available for long term. It can, psychologically you are much better prepared to handle the volatility, to ride over those volatile phases of the market, and allow the underlying companies to dole out their performance, and the performance getting reflected in the market values.
Right. And with this, so currently what's happening is, due to COVID, a lot of investments that have come into the markets as well, because you see the quantum of digital trading that's gone up. So
Right.
what should one's mantra be of investing in these current times? And which sectors, according to you, could be wealth creators from here on?
Uh, you see, the day trading is not just here. It's, I think, what is called as Robin Hood investors have come all over the world as a consequence of COVID-19 and people sitting at home, perhaps. This is not yet concluded, by the way, but this is the conjecture that all of us are carrying. There is a good and a good element to it, and there is not so good element to it. The good element is that it's kind of getting people giving people exposure to equities investing, which anyway in our country we are under penetrated. So
Hmm.
this will allow, okay, even if some people were to make initial mistakes, this will allow people to eventually, get their act together and have their, according to their own risk profile, they will start looking at investing in equities and building their equity
Hmm.
portfolio. So it's actually that bodes very well for our country as a whole. The not so good part is that some people can burn their hands, because the whole the whole phenomena of making money tomorrow. I invest today, in a few days I see the stock going up by 5-10%, and therefore that kind of is a self-fulfilling prophecy. It happens in every cycle, but because of COVID, perhaps it's happening at a much larger scale. That is something which is of concern. And again, for an investor, therefore, one should stay away from investing in companies where one doesn't have enough information, or one is not, it's investing on hearsay, investing on pure technicals, just because of the momentum is some. So I'm again restricting my comment to small caps and mid caps, or not the
Correct,
large caps.
correct.
So I would say that that's not advisable when it comes to small and mid caps. That don't rely exclusively on technicals. Just go back it up with fundamentals, back it up with some theses, and then of course you can rely on technicals for timing the market, because technicals have their own has its own role to play for people who trade shorter term. So I would say that that's what they should be doing. Now, in a post-COVID scenario, we are going to witness some very good investment opportunities, and maybe some certain sectors which, at least for the moment, may have to be avoided because the outlook for them is not clear. The need for example, and the need for airlines and for us to fly is very clear, but how long it is going to take for airlines to get back to their normal loads, and they have very high break-even points, we don't know. So it's best that we choose to stay away from airlines right now. However, a lot of the companies and lot of the sectors which may see a lot of whose outlook may have bettered post COVID. Uh, let's look at healthcare, and I'm just going to take a minute because I'm going to talk a little differently about healthcare, and healthcare also encompasses pharmaceuticals, because ultimately that goes into the healthcare. See, what has the world realized when COVID broke out? That even the most advanced countries were not prepared to deal with a pandemic like this. And the healthcare systems all over the world got overwhelmed. Uh, India though was completely underprepared, and therefore we went into the strictest lockdown so that at least we can, we get that time to mentally as well as physical infrastructure wise prepare ourselves. But even the other countries of the world where we thought that they have the best healthcare systems in the world, they got overwhelmed. So I am seeing that once the dust of COVID settles down, Hiral, we are going to see massive investment in the healthcare infrastructure all over the world. Country after country, knowing that they have aging populations, they have faced some very, very, horror-like moments. They are going to make healthcare, make a more dependable and a more robust healthcare infrastructure as a priority. Now, imagine where how this can benefit a lot of Indian companies, who whether they are from the medical devices space, whether they are from the pharmaceutical space, or whether even they are from the like engineering space, who are making those equipment that go into building of the healthcare industry. So not just India, even India will have to now, maybe a couple of years down the line, we may have a specific government initiative to improve our right from primary to tertiary healthcare infrastructure, government. So why I believe that it's a great opportunity. One has to look for the right kind of a stock, and have that 5 year plus horizon. And there is it's a global opportunity. And put that into the context of China plus one, where Chinese suppliers are not being favored for a number of reasons. Then obviously Indian companies are likely to be big beneficiaries. Similarly, rural consumption with one rural sector has been far more resilient during these COVID times. Agricultural output is at a record high. And then this passage of the farm bill, which allows for direct access of farmers to the markets. Both this combining this together is a game changer, and this will lead to a lot of money in the pockets of small farmers, and that will lead to spending by the small farmers, and having a far more a multiplier effect in terms of the consumption. So we
Correct.
believe that rural consumption is something which you should look at, and there are multiple plays within that rural consumption theme, from the foods to the FMCG to the two-wheelers. You can choose and pick, what you want. Uh, One other theme which looks very robust to play right now in a post-COVID, not necessarily it has anything to do with COVID, but what has happened post-COVID is that the need for us to upgrade our aerospace and defense infrastructure technologically is now, because of what's happened on our borders, is now
Mm,
very, very, it has become a priority. And the government's focus on Atmanirbhar Bharat, where, they want to indigenize. And when I say indigenize, is not,
mm,
they don't want to indigenize, it does not, they want to have production and designing and technology in India. So what they've done is they've opened up 76%, 75%, 74% FDI
mm.
in defense, which allows foreign companies to come and have a control over here. Now,
Correct.
this again will lead to huge opportunities, and there are a handful of defense companies already listed, but you may find more companies, maybe from the automotive space, maybe from the
Mm,
like what Bharat Forge has done. They went into defense. So some other sectors, engineering and tech companies going into the defense sector, and
mm.
playing that defense cycle. So one should look out for some of these plays as the government's focus is also shifted, and ultimately these companies have the opportunity, like the automotive companies, to then get integrated into the global supply chain for parts and subsystems.
Correct.
So that's the other, I would say, sector that one can look at. And finally, tech, where you have companies that have IP products. Digital transformation is a massive theme,
Mm.
and I think there'll be a bunch of small and mid caps that will emerge as big winners here. So look for digital transformation theme.
Right. So these are sectors that could be emerging as good bets and multi-baggers as well. There could be few out of these sectors that Sandeep has been mentioning post-COVID from here on. Thank you, Sandeep, so much for joining us on the show. Great insights that we've picked up, especially with regards to where broader markets are concerned right now, as to what are the risks associated, what are the factors we should be watching out for. And I'm sure this has been a useful session for all our viewers as well. Thank you so much for joining in. I hope you enjoyed the discussion as well.
Thank you, Hiral, and thanks to Nirmal Bhan for inviting me to this platform and share my views. Thank
Thank
you, Hiral. Goodbye.